Good morning, everybody. I hope that everybody who's going to be joining us has been able to get online. Thank you so much for spending your time with us this morning. We really appreciate it. Hopefully you can see and hear me just fine. My name is Mike Caraway. I am a partner with GranthamPoole. I'm the leader of our advisory services group. Wanted to welcome you to our webinar this morning. I promise you're not going to have to look at me for very long, I assure you, nor are you going to have to listen to me for very long, because we've got a great panel of speakers to talk to you, and we're going to talk about them in just a minute. But first, again, welcome. You're going to hear us say thank you more than a couple of times. We really appreciate your taking the time to spend with us this morning, or if you happen to be later watching the recorded session, because this should go up on our YouTube channel. And of course, as you're going to hear, the stuff we're going to be talking about, it's very much real time, and things are changing very quickly. So this material will become dated fairly quickly, but we're glad you're with us today to talk about what's going on right now. You would think that a bunch of accountants would be living their dream, having very little human contact right now, but frankly, we've been very busy talking with clients, with a lot of folks working through what's been a very difficult time. Obviously, there are more important things than dollars and cents going on right now, but the state of business, people's finances, their tax profiles, these things are very important to people's lives, and that's the sort. And we're going to be talking about this morning. So we hope everybody is staying safe, and we're glad to have this opportunity to talk to you in this way. So before I talk about our subject matter, I do want to introduce to you our speakers, and you're going to be hearing a lot from them in just a few minutes. So they are, and I think you should now have that on the screen in front of you, and not me. So you're welcome for that. So you've got in front of you myself. Again, my name is Mike Caraway. I've told you a little about me. Let me tell you about Brad Hatchett. Brad also is a partner here at GranthamPoole. He heads our firm's audit team. Brad actually has done a lot of work with clients over the years in the areas of financing, sometimes SBA, Small Business Administration financing. So he was uniquely suited to get involved with the subject matter that we're talking about today several months ago, when it became a thing, as they say, that being the Paycheck Protection Program. Brad, along with myself and others, including Stephanie, who I'm going to introduce in a second, have spent a lot of time on this topic and related topics the last few months. Stephanie is also with us this morning. Stephanie Smith, also a partner with us. She's the leader of our litigation support and forensic accounting group. She has actually led our efforts in tracking legislative updates and SBA and related guidance, things on both the federal and state levels, as we've gone past the last 5 months. The last 5 months have felt like 50 years in some ways, and Stephanie has been at the tip of the spear in making sure we stay caught up with what is going on in real time. So she has also been working with a lot of clients on PPP and related matters. So I'm really, really grateful for Brad and Stephanie for being with us today. And I'm grateful. I'd just like to also say thank you to all of my partners for giving us all the opportunity to visit with you today and take the time to do this. It's not an easy task, gathering all this information, a bunch of accountants mastering technology to be able to talk to you this way. So we are certainly appreciative of the environment that we work in, that we're able to do this. So let's talk a little bit about the subject. So if we can go to the next slide, stating the obvious, in March, everything changed. Now, you could argue that maybe it was before March and some significant things have happened since then. But I remember for us in March, we basically all went home. A lot of us started working remotely. Families were finding new ways of doing school and life. Masks became a normal part of life, and businesses were severely impacted. Businesses are still being impacted. When a restaurant can't have patrons, when a beauty salon can't have customers, it affects them severely. And those are just two examples. Businesses across the spectrum, across the nation, across the world have been impacted. So in March, Congress took action, and there's been a lot of action taken since. But in March, the CARES Act was passed. It was signed on March 27th. There were a lot of provisions in the CARES Act that are very important. We may touch on a couple of them today. The primary focus today, though, with respect to CARES Act provisions, is the Paycheck Protection Program. You will hear us say that term, or PPP, multiple times this morning. Now, the intent, not to oversimplify it, but the intent of the PPP was to keep people employed, to put money into the system, into businesses that were struggling, that are still struggling, to keep people on the payroll, whether they were working or not. And there's been plenty of both. That is what the PPP was designed to do. Hundreds of billions of dollars have been pumped into the system, into businesses, to fund people's payrolls. And by all evidences, it has worked. The economy is not in great shape right now. No one would argue that it is, but the PPP does seem to have worked. Regardless of your political ideology, whether you think it was a good idea or a bad idea, it seems to be doing what it was designed to do. And of course, a main feature of the PPP is that it is forgivable if you follow certain rules. I've got a couple of things listed there, talked about the intent. Initially, the way the loan was computed is based on payroll of over a 2.5-month period. Initially, there were 8 weeks during which the funds were to be spent in a certain way, in certain ratios, to get forgiveness. That's been altered, changed, loosened up over the last few months. We're going to talk about some of that. But the key there, the driver in all of this, has been forgiveness. That's what made the PPP so attractive. A loan that turns into a grant if you do certain things. The primary thing being pay your people. Now, that's oversimplifying it. We're going to talk about that because now we're entering into the forgiveness phase. The SBA started taking applications August 10th. Many banks have only in the last few days gotten ramped up to take applications because this is a monstrous project for banks. They've been doing a great job on this. But now we're entering the forgiveness phase, and that's a whole new phase, a whole other level of complexity. And that's what we're going to talk about today. And that is the mechanics of forgiveness, what we know today, what we suspect today, and what we might be finding out in the near future. Now, again, I've introduced our other speakers to you, Brad and Stephanie. Brad is going to walk through with us the mechanics of forgiveness as we understand it today, and and possibly also talking about what could happen in the future, or at least our thoughts about how people may want to proceed. And from there, we're going to go into a few other avenues, but for a few minutes, we're going to talk specifically about what is on the mind, I think, of everyone who received a PPP loan, and that is, what do I do to get partial or complete forgiveness? So with that, I'm going to turn it over to my partner, Brad Hatchett. Brad?
Thanks, Mike. Let's go to the next slide, and I think probably the best place to start, Mike did a good job of setting the stage, explaining kind of how we got into this PPP world. And I think probably a good place to start would be to hit the high points on kind of how the forgiveness process works, the basics of forgiveness, if you will. And probably the most important thing, I'm going to talk about really more about the rules that we're operating under now as opposed to the way they were set up under the CARES Act originally, because there was an important piece of legislation that was passed in early June. I think June 5th was the date that that bill was passed, and it's called the PPP Flexibility Act. And essentially what this did was enhance or modify the PPP program that was originally included in the CARES Act. And it did a number of things. Probably the one that's gotten the most press and discussion, I think, was probably the most well received, was an extension of the forgiveness window. So as Mike mentioned before, the CARES Act had an 8-week forgiveness period. The Flexibility Act added 16 weeks to that, bringing it to a total of 24 weeks over which you could spend the funds that you received. This was really a very welcome change for a lot of businesses that were struggling because the economy was much slower to open, I think, than Congress or anybody else anticipated it would be when the CARES Act was passed. So having an additional 16 weeks to spend the money was important. As Mike mentioned earlier, the intent of this program was to get money into the system, into our economy, to help stimulate the economy, keep people working, allow employees to continue to draw paychecks, help businesses cover essential overhead, things like that. So the Congress never intended for the money really to come back or to be paid back. And in a perfect world, they would have liked for all recipients to be able to utilize all of the money. And with an 8-week forgiveness period and a slow restart on the economy, that was proven to be challenging for a lot of businesses. So the extra time was much needed and important. I think it certainly helped a lot of our clients and businesses that we interact with be able to assure that they can spend all of the money that they received. The other thing I want to mention is allowable cost. This has been talked about a lot since the beginning, so most everybody who has a PPP loan is probably familiar with this, but just to reiterate, there are certain expenses that if the money is used for those purposes, you can be forgiven for those expenditures, and those are payroll cost, which is a bit of a broad concept, but it includes salaries, wages, tips, similar compensation, retirement plan contributions on behalf of the employer, healthcare cost, federal and state unemployment taxes, things like that. So it's sort of an all-inclusive term. So we just use the term payroll cost, but the largest component typically for most businesses is their actual salaries and wages that they pay their employees. Rent for your office space, that also can include operating leases for things like office equipment, fax machines, copier leases, other equipment. It's not specific to real property leases. Utilities on your space, and then if you happen to own your own building instead of rent and you have mortgage interest, you can include that mortgage interest as well. One of the other important points to note is that under the Flexibility Act, there's a threshold that 60% of the money should be used to pay payroll costs. So those items that I talked about that were included in payroll costs, at least 60% of the money that you received on your PPP loan must go to pay those payroll costs. If not, there's a potential reduction in your forgiveness amount if you don't hit that threshold. Under the CARES Act, that threshold was 75%, so lowering the threshold to 60% helped a lot of businesses that were struggling for a number of reasons. Maybe they weren't able to bring their employees back as quickly as they thought, or maybe they have an unusually high overhead load as compared to payroll, that their office space, mortgage, rent, utilities, things like that were higher than their payroll costs. So lowering that threshold helped where that's concerned. What we've seen in practice is that with the additional 16 weeks of time to spend the money, many businesses are able to clear the 60% threshold with ease. And I've got a lot of clients I work with that ended up using 100% of the money on payroll related costs just by virtue of having the additional time. So for a lot of clients and businesses we work with, the 60% was a pretty low hurdle to clear. But if you find yourself in that situation where you're struggling a little bit, certainly you want to do everything you can to make sure you hit that threshold so that you get full forgiveness. Another important point to make sure everybody's aware of is that there's a proration on forgiveness for a couple of situations that may occur if you reduce your head count during the forgiveness period or don't bring workers back, or if you were in a situation where you had to curtail wages. If you did that as well, there's the possibility of losing some of your forgiveness. The 60% threshold is an interesting one because if you don't spend at least 60% of the money, there's a proration on forgiveness, but it affects both sides of the equation, both the payroll and non-payroll cost, the way the math works on that. So you have to be careful, particularly with that one. What's new with the Flexibility Act that was passed in early June is a set of exemptions available to give people sort of a get out of jail free card, if you will, on the proration in certain circumstances. And we'll talk about that in just a little bit when we dive into some of these elements in a little more detail. But there is an out in certain circumstances if you have reduced head count. And so we'll talk about that in just a minute. So let's go to the next slide and talk a little bit more detail about the covered period. So the covered period is 24 weeks from the date of loan funding. Most everybody's aware of that. If you happen to be someone who received your PPP loan before June 5th, which for most of our client base and businesses we deal with is virtually everybody. But if you received your loan before June 5th, you can opt for a shorter forgiveness window and stick with the original 8 weeks. So if you happen to have been able to spend all of the money in the 8-week period without any trouble, you can opt for the 8-week period. Some of the reasons why you may want to do that is it limits the amount of time. If you're a company that doesn't qualify for one of the exemptions on headcount that we'll talk about in just a little bit, you don't have to track your full-time equivalents during your forgiveness window for as long if you stick with the 8-week period. So that may be of benefit if you've used all your money to opt in for the 8-week period. All of the other provisions in the Flexibility Act continue to hold even if you opt for the 8-week period. And so we'll talk about those in a little bit more detail in just a bit as well. Another important point to make everybody aware of is that there was a little bit of confusion when the CARES Act was originally passed about how you were going to measure payroll costs, particularly if you happen to be funded on your loan in the middle of a pay cycle. So for those businesses that pay biweekly or more frequently, biweekly or weekly, then there is an option for what's referred to under the SBA guidelines as an alternate payroll covered period. And basically what that allows you to do is measure all of your non-payroll costs on a 24-week period starting at loan funding, but for payroll costs, you can start measuring your 24-week period on the first day of your first full payroll cycle after loan funding. So basically it allows you to wait until that first pay cycle starts and start the clock on the 24 weeks for just payroll costs and run for 24 weeks measuring payroll cost. And then when you get to the end of the period, there was is a provision in the bill that says that the costs have to be incurred and paid during the forgiveness window, and the SBA release guidelines that basically say that you don't have to, that final payroll, which may actually get paid outside of the forgiveness window, you can still include that in your payroll cost as long as the wages were incurred during the 24-week period and paid on your next regularly scheduled payroll cycle.
You know what I remember about this, Brad, and I should have told everybody when we started that we like to do our presentations as much like real-time conversations that we have in the office as possible. So forgive us if we sort of talk to or at each other a little bit. It's what we do when we're here. But I remember, and I know you remember, and I know Stephanie does as well as a number of our other partners who worked through this, that early on, this was a disproportionately large headache, right? I mean, we were focused on a lot of technical stuff with regard to FTEs. What exactly does the bill say? But as people were getting the loans in real time in early April, they would say, well, I received my loan on Wednesday, and you've told me that's when my period starts. I'm running payroll on Friday and it's for 2 weeks, but you told me it has to be incurred and paid. This doesn't sound like it's both those things. And we didn't have a solid answer because the guidance that you're talking about now didn't exist. So what we were telling people was some version of pay it. Hopefully there'll be some common sense guidance that comes out, but that was just one example among many of how the track was being laid in front of the train as it was going down the track at 80 miles per hour.
That's a good point. The payroll period clarification actually came from SBA guidance. It was not a part of the Flexibility Act, but it came significantly after the PPP program was rolled out and they began accepting applications for loans. So as you mentioned, a lot of our clients had received money. We're paying payroll costs and trying to figure out when should they start tabulating and counting those payroll costs. We came up with a couple of different alternatives internally about how to recommend people do that. And one of them was, well, you just start counting you consider it based on the date paid as opposed to incurred, and maybe you just don't count your last payroll because it'll be paid outside the cycle. We had a couple of different ways. Interestingly, as it happens, the method that the SBA chose, this alternate payroll cycle, was completely different than any of the methods we had come up with. But it does make sense the way they do it. It's relatively easy to track, and it's for those that are biweekly or more frequently, it tends to line up nicely for most people. If you're a biweekly pay, you may actually end up, depending on how your pay cycles work out, you may cross over a pay period. But for most, that if you're biweekly, it should work out if you go the full 24 weeks, which we'll talk about that in just a minute. That should be roughly 12 pay cycles. So everything should work out well for those. If you are a monthly or semi-monthly payer, you're still going to have to do some proration mathematics on the backside to make sure that you're only covering payroll that happened during your covered period.
Well, I'll take this moment to interject this as the master of the non sequitur. You gave me an in and talking rightly about how a lot of the guidance that we do have now is not necessarily part of the legislation that was either in or followed up the CARES Act and the Flexibility Act. It's in direct SBA guidance, just to give folks a look into some of the unintentional humor with which we have dealt, and everybody who's been touching these things has been dealing the last few months. I'm reading from Treasury's website right now some of these rules that some have been superseded, some are still in force, but these guidance and their FAQs that they would put out, I'm going to read the title to one of them, not necessarily applicable to this particular situation. Interim final rule on revisions to the 3rd and 6th interim final rules. We were getting interim final rules and interim final rules that would adjust those, and everything. I think you've said this before, Brad. Everything seemed to have the word interim attached to it because they knew we're creating as many questions as we're answering with this. We got to keep going.
Yeah, that's it's funny that we're 5 months in to this program. Many of our clients have spent their money and are preparing to apply for forgiveness, and none of the rulings that have been issued by the SBA are considered to be final rules at this point. So I guess at some point they'll close the loop and shut the rules down. But it has been interesting, and to your point about the changing landscape, even as early as Monday afternoon, as we're preparing to final production on this webinar, the SBA has issued some guidance, another interim final rule on loan forgiveness on 2 specific matters, which hopefully we'll have time to circle back to at the end of the webinar. But the landscape changes quickly, and so we're having to stay on top of this and make sure that we have the most current guidance. But hopefully we can give you some kind of hot off the press guidelines on a couple of things related to forgiveness when we get to the end. So let's go to the next slide and talk just a little bit about allowable cost. I'm not gonna belabor this too much because I think most everybody's fairly familiar with this, but rent, utilities, and mortgage interest are 3 of the items I mentioned earlier. The caveats there are that all of those items have to have been either leases or service initiated on utilities or a loan originated before February 15th. If any of those dates that those services or leases started was after that date, they're not allowed to be included. Payroll cost is probably the most nuanced of the group, and there's a couple of important things to note there. I think most everybody's aware there's a $100,000 cap on wages. That's not $100,000 paid during the 24-week period, but on a prorated basis. So you essentially take the wages, $100,000 divided by 52 to get your weekly amount, and then that essentially tells you if you multiply times 24, that's the most you can pay somebody during that forgiveness window, and count it towards forgiveness. Anything else is excluded from that. Owner's compensation falls under the same $100,000 cap. There's an interesting component to owner compensation that actually came in some SBA guidelines that were released after the Flexibility Act was passed, and that has to do with some concern that by extending the forgiveness window an additional 16 weeks, if owners continue to draw pay at a rate of I can't remember exactly I can't do the math in my head that quickly, but 100,000 divided by 52. So if you continue to pay at that rate every week for 24 weeks, that it would put owners in a position of maybe being tempted to consider a reduction in workforce if they didn't need all of their employees, and then to continue to pay themselves. And Congress and the SBA didn't want the Flexibility Act to turn out to be a windfall to business owners. I think that was the terminology the SBA used in their guidelines. And so the intention was to effectively cap owner compensation at 2.5 times your 2019 monthly average, which for most people should have been the baseline that was used when you calculated your loan amount when you were applying for your loan. Most everybody used 2019 payroll, which was kind of the common position. So if your owner compensation was included in that number, 2.5 times that is the max that an owner can be paid using that money. Now we'll talk about it at the end when we get to the guidelines that were issued on Monday, because one of the clarification points has to do with that specific item. So I'll kind of tell you how that's changed when we get to the end there. But so let's talk a little bit about forgiveness prorations. I mentioned earlier that there are certain circumstances where you may not receive full forgiveness, and so these pitfalls are things you need to be aware of and be watching if you haven't already. And some of this may inform what you decide to do with respect to when you apply for forgiveness, and we'll talk about that in just a minute as well. But generally speaking, if you use less than 60% on payroll costs, then there is a proration that happens where you lose a portion of your forgiveness, and you actually end up losing forgiveness on both sides of the equation, as I mentioned, both the payroll and non-payroll costs. So that one you have to take particular caution towards. But as I mentioned before, most of our clients aren't really struggling with this particular issue because they had an additional 16 weeks to continue to pay employees and utilize the money. So, but if you find yourself in that situation, if you need somebody to help, guide you there, certainly we can do that, or you can talk to your CPA or professional that may be helping you with this. Wages, if they are reduced by more than 25% for any employee, so if it's a salary employee, if you cut for some reason because of the economic situation, if you had to ask employees to take a wage cut or wage reduction to survive the economic storm, if you trimmed wages by more than 25% or hourly wages for an employee by more than 25%, then you have to restore those wages during the forgiveness period or be subject to proration and forgiveness. And then if you reduced your full-time equivalents, if you had a reduction in workforce, you either laid off employees before the PPP program was introduced and you received your loan, there's a cure period where you can bring those employees back, rehire them and restore their wages. If you weren't able to do that for some reason, then there's a proration that happens on forgiveness there as well. So the FTE measurement is an important one. Most of you will remember there's a base period that you measure your full-time equivalents against. So you calculate full-time equivalents during the 24-week forgiveness period, and you measure that against, for most businesses, your average full-time equivalents during the period January 1st to the end of February 2020. So it's about a 2-month period there where you would calculate your FTEs and then measure your forgiveness period against that. There is an option if it's more favorable for you it was really intentionally designed for seasonal employees to look at a comparable period in 2019 that comparable to when the forgiveness period overlaps for this year. So I can't remember exactly what the dates are right off the top of my head, but it's April to June of 2019 roughly. So if you found yourself in that situation where you're a seasonal employer, you can look at that. Or if you're not a seasonal employer, but it's more favorable for you to use that, then you're able to use that base period as well. There's a couple of exemptions to the FTE measurement that are important, and these came out of the Flexibility Act. So in the spirit of trying to help businesses spend the money and to keep the money in the economy, and as opposed to having it paid back. If you were in a situation where you can document that you were unable to rehire employees that were previously furloughed or laid off, so you called your employees back and for whatever reason they didn't come back to work, and you can demonstrate that you have tried to hire a similarly qualified employee to fill that position and were unable to do that, then you get an exemption. So essentially, if I tried to bring my people back and they decided not to come back through no action of my own, and I tried to find somebody to fill that position and couldn't, then you get an exemption there. Also, if you are able to document that you were unable to return to the same level of business that you enjoyed before the pandemic because of guidelines that were issued by the CDC, Department of Health and Human Services, OSHA, government authorities, essentially. And the things that we're thinking about here are things like restaurants that weren't able to go back to full capacity because they're having to sit patrons at every other table, or have to wear masks in the restaurant, or they have to do extra cleaning in their space that limits their ability to return to the same level of business. Then social distancing, things like that you can get an exemption for that if you're able to document that. This one, probably for lack of a more eloquent term, is the murkiest of the exemptions, because the SBA has not issued any guidelines on exactly what it takes to fit in this box, and it's a fairly wide berth. So I could see a number of people being able to document that they might fall into this category, and the unfortunate fact is right now we don't have a lot of guidelines to know what it takes to fit in this quadrant, so to speak. So I don't know, Mike, if you or Stephanie have any thoughts or comments there, but I think we've envisioned a number of clients that may fit there. We just don't know for sure if they will or not, and may not know until we apply and see what happens. So.
Yep, I completely agree. As an attorney friend of mine has noted, you never want to be a named case, so to speak, but at some point somebody may just have to give it a shot and see what happens. If you think you legitimately fit in that category, but it is murky. I think that is an appropriate term. I know you and I have talked about this quite a bit, and a number of others in the firm as well. Is what does it take? I mean, if you could cast a fairly broad net and say, do you know anyone who owns a business who has not been significantly impacted, whose business is not at a normal level? I can count on one hand and have a couple of fingers left over folks who've been completely unaffected. But where's the bar, and what are the technical requirements for it? And we'd really like to have some guidance, because again, I don't want to and can't give anybody any assurance that they're a slam dunk for this without some additional guidance. And it makes a difference, right, in terms of how you apply. And I know you're going to talk about that in a second. I don't want to belabor the point because we got to keep moving, but how you apply the information you have to disclose, frankly, how hard the application process is or is not, depends greatly on whether you would fit into one of those categories or not. And it's understandable that we are where we are with lack of guidance, but it's certainly frustrating because we have folks who are eager to go ahead and put this behind them, but and we feel like we've got runway to be patient. We're going to talk about that more, but just not being able to guarantee which side of the line they fall on is somewhat frustrating.
Yeah, that's probably a good segue to the next slide. Let's go there, and we'll talk about the application process. As Mike mentioned, those exemptions really help determine how you apply for the loan. So just as a general overview, you would apply to the bank that made your PPP loan. I think most everybody's aware of that provision. The SBA has released 2 application forms. Both of them are available on the Treasury Department and SBA's websites in PDF form if you want to look at those and see what the requirements are. There is instructions to each of the applications. The first is what they refer to as an easy application, and it is exclusively for businesses that meet one of those prior two exemptions that I mentioned on the prior slide. So if you weren't able to bring your employees back and couldn't find a suitable replacement, or if you weren't able to return to the same level of business, then essentially you get an exemption on full-time equivalents, and you don't have to measure or substantiate those. And so the easy application excludes that measurement from the application process and the documentation requirements, as compared to the long form, which is a more comprehensive application and does require you to tabulate your full-time equivalents, to measure those against your base period, and provide documentation to that effect. So the easy application obviously would take less time to prepare and require less effort and substantiation, but you can only do that if you meet one of the exemptions. So Mike, to your last point about that last item, certainly it would be to a business's benefit to try to figure out if they can fit in that particular exemption so that they can fill out the easy application. But again, the guidelines are scarce right now with respect to that item. So we'll see what happens as the application process continues. Some banks may accept the PDF applications. A lot of the banks in our area that we've worked with have online portals. So I would probably, as a word of caution, say download the applications, look at the instructions, call us if you have questions, and we certainly can help you work through that. But be aware that you may not want to spend a ton of time filling out the PDF application until you're sure, what form your bank expects your application to fall in. The web portals that a lot of the banks have built are designed around the PDF one, so have the same questions on it, but you have to put them into a web form. It's probably the biggest burning question most people have is, when can you apply or when should you apply? And we draw that distinction because I think it's important. The deadline for application is 10 months from the end of your covered period. So for most businesses, we have a lot of runway. Many of our clients are just now finishing up spending their money. Most everybody's 8-week period has run some time ago. Many of our clients are in the tail end of their 24-week period. Some have already expended all of their money. Others still have money to spend but haven't concluded their forgiveness period. And so under the CARES Act, the application had to happen within 60 days after the close of your 8-week forgiveness period. So we have considerably more time now to do that. An important point to note, though, is that the SBA didn't even open up its portal to receive applications from the issuing banks until August 10th. So we're 15 days in now to that process. So if you're nervous because you haven't applied yet, we're still very early in the process. So don't let that be of concern to you. And then even though the SBA opened their portal, many of the banks that we work with, there were some, I think, that opened around August 10th, but some of the larger lenders in our area that we work with a good bit have just now started to open their portals. Some opened them early this week, a few at the end of last week or over the weekend. So again, don't be concerned that you haven't done anything yet. I think it's certainly still a new process, and we're still trying to work through that. As far as when should you apply, just because you can doesn't necessarily mean that you should at this point. And so I'll mention a couple of cautions. Everybody's situation is fact dependent, so you really need to think through your specific situation. We have a number of clients that have reasons that they need to apply. Maybe they're in the midst of a transaction and need to go ahead and clear the deck on forgiveness to do that. But the concern that we have, and I think most in our industry have, is the fact that the SBA specific guidelines on forgiveness are very limited and scarce at this point. And what we saw, as Mike alluded to, is there were a lot of things that changed during the loan application process, and sometimes to the detriment of some of our clients who applied early, and then the guidelines changed. So as a general rule, we think it's probably best, if you can wait, and let's see how things develop out, see what kind of guidelines come out, and make sure that you're not that you're not harmed in the forgiveness process inadvertently. And then also Stephanie's going to mention this in just a few minutes, but there's some pending legislation that affects forgiveness. One provision which may actually grant automatic forgiveness to loans of a certain size, and then there are some provisions that may limit the documentation you have to turn in if your loan is of a certain size. So it may be prudent, if you may fall under one of those categories, to consider waiting and see, because the last thing you'd want to do is spend time and energy and money and professional fees paying somebody to help you with your forgiveness application, only to find out you didn't need to do that. So,
right. Yeah, we always love the business, but we had to do a project for somebody, need to bill them, and realize a week later that with new guidance we didn't need to do it. So thank you for that, Brad. I am going to keep us moving right along, because believe it or not, we've got some stuff to discuss besides PPP. Now, Stephanie's going to talk to us now about certainly some coming things, as Brad mentioned, some things that we may see coming, but also some other available assistance. Some of it actually pre-existing before the PPP. A couple of things that are newer. Our goal is certainly to get everybody out of here right at or about 11 o'clock, for those of you who want to hit an early lunch. So I'm going to interrupt you very little, Stephanie. I've already introduced you. Stephanie, of course, has a lot of thoughts to share on the PPP, a lot of which we've just talked about. But there's some other things that we wanted to make sure we mentioned to you. So Stephanie, take it away.
Thank you, Mike. Although the Paycheck Protection Program was probably the most attractive of the business assistance programs in the CARES Act, there are some other things that I'm going to tell you about. One was the Economic Injury Disaster Loan. Now, this is sometimes referred to as the EIDL or EIDL loan. This is a program that's been around for a long time, and it's administered by the SBA, but it was tweaked a little bit for the coronavirus season by the CARES Act. It's administered through the SBA, not your lender, like the Payroll Protection Program is. And it's for businesses with 500 or fewer employees. You can get a loan up to $150,000, and you can have that loan for up to 30 years. The interest rate is like 2.75% for a nonprofit, or 3.75% for a for-profit business. And the funds can be used for paying debts, for payroll, accounts payable, and any operating expenses. There are a few things they cannot be used for, and that would be business expansion or the purchase of fixed assets. So it seems like a very favorable loan option for most businesses. Why would you get one? Well, it's favorable, and you may have spent all your PPP money and need additional funding. But there may be some reasons why it's not a good solution for you. There could be a downside. Now, here would be the downsides. It's based on your credit history. You do have to have acceptable credit. But you do not have to show that you've exhausted all other possible sources of credit. It does require collateral if your loan's over $25,000, but you do not have to have a personal guarantee. You cannot take on additional debt. It puts the SBA in a less favorable collection position. Now, that's something to consider if you have this loan for a long term. And you cannot make distributions of profits to the owners that are in excess of what they would normally receive from the business as long as the loan is outstanding. So good financing good terms, but some caveats on how it can be used and how it may impact you a little bit later. Now, also, there are a couple of payroll tax items that have come about that are available to every business owner. The first one came out in the Families First Coronavirus Response Act. That was the first piece of legislation that really came out maybe in February that related to COVID-19. And it required businesses to pay their employees for sick leave or expanded medical leave for any reason related to COVID-19. Because it was a requirement or sort of an unfunded mandate, business owners could get a credit, a tax credit for 100% of the wages they paid for this COVID-19 sick or family medical leave. Now, there's some limits to it, but it's basically an act which said, if you pay it, we will pay you back. This credit is taken on Form 941 that the employer files. Then, and when the CARES Act came out, we had another credit that was created called the Employee Retention Credit. And it provides up to $5,000 per employee of credit, and it's equal to 50% of the wages they're paid from March 13th to December 31st, capped at $10,000 per employee. And this is available for businesses that have their operations suspended by government order. And that is, any government order, state, federal, local, or they had a decline in receipts of 50% compared to the same time last year. So this credit is available to these businesses that were shut down and continue to pay their employees during this period of March to December. If you had a Paycheck Protection loan, you cannot take this credit. And then the third thing that has to do with payroll taxes is a payroll tax deferral, where any employer can defer the deposit and the payment of their portion of Social Security taxes, not the part that's withheld and not the Medicare tax, but the Social Security tax that's due between March 27th and December 31st. They don't have to deposit that until half of the amount deferred at the end of 2021 and the other half at the end of 2022. So, this is another cash flow stimulation for businesses with employees. Now, smaller, but just as important, I believe, are the Mississippi incentives for businesses. The first thing we have was signed into law in May of this year, and it's a grant program for businesses with 50 or fewer employees, and it's called the Back to Business Program. And the requirements are very straightforward and things you would expect. You have to be a for-profit business. You've got to be in business March 1st of 2020. And then you have to be in good standing with the Secretary of State, have filed your Mississippi taxes for 18 or 19, or if you're a new business, plan to file in 2020. You have to have suffered an interruption of business, and then you can't exist for political purposes or get your income strictly from passive investments. The eligible expenses that you can include in your application fall into two categories. One is expenses for public health measures, and this would be cleaning, PPE, teleworking costs for your employees, anything new that you had to do because of COVID-19. And then also the second category would be expenses due to business interruption, which are just like the ones we've already talked about: rent, payroll, utilities, interest on debt. The things that are not eligible would be lost profits or any kind of damages reimbursed by insurance or another program, or severance pay. The maximum grant amount is $25,000 per business. And they're reduced by a couple of things that probably won't affect many people. One is an idle advance. And when I talked about the economic injury disaster loan, I didn't even mention this, but when it first came out, you could get a $10,000 emergency advance. They quit doing that after a while because the money ran out. But if you got one of those, you have to reduce your grant by that amount. And then if you had business interruption insurance and it paid off, you should reduce your grant by that amount, but never below 50% of what you've applied for. So if you applied for the maximum grant, you had received a $10,000 advance, it would reduce your grant amount to $15,000. If you had received $20,000 in business interruption insurance, your maximum grant is going to be $12,500. It cannot be reduced below half. This program is administered by the Mississippi Development Authority, and the application is online at that website, backtobusinessmississippi.org. The application is fairly simple, but if you need help, we'd be happy to help you. Now, there are a few other avenues of Mississippi assistance. One was some COVID-19 business relief payments, and those were administered by the Department of Revenue. These were $2,000 automatic payments that went out to certain businesses. Originally, those businesses were things like daycare centers, salons, gyms, restaurants, things that were shut down and didn't really have avenues for relief. The eligible business list has been expanded since then to include other things like bars, caterers, tourism businesses, and all of those are listed on the Mississippi Department of Revenue website. Like I said, this payment was automatic, but if you did not receive one and you think you should, you can check the website, and then there's a number for you to call to contact and verify that you should have. Finally, the governor signed a bill that provided for some relief for specific businesses for necessary PPE expenditures, and this went into effect July 1st. And it provided $4,000 for each dentist in private practice. It provided $2,500 for physicians, nurse practitioners, and optometrists in private practice, and it provided $25,000 per practice group of physicians. So these were this was to allow these businesses to spend the money they needed to on personal protective equipment. Now, the question that we're going to end with is there more relief on the way? And the answer is we think so. Back in May, the United States House of Representatives passed the HEROES Act, the Health Economic Recovery Omnibus Emergency Solutions Act. In my retirement life, I want to come back as the federal acronym maker.
Stephanie, I'm sorry. I've been restraining myself to keep from interrupting you, but every time we talk about these acronyms, I get tickled. I don't know if the acronym comes first and they try to reverse engineer the terminology, or if they play Scrabble with the terminology to come up with a decent acronym.
I think anytime you put omnibus in the acronym, you're stretching.
Anytime you need an O, just use omnibus, right?
Omnibus, right. Anyway, I do wonder if there's really a job, federal acronym maker. Anyway, the HEROES Act was passed by the House in May. It was a $3 trillion proposal. And then in July, the Senate came up with its own bill called the HEALS Act, which was the Health Economic Assistance Liability Protection in Schools Act. They are very different in some regard, but they do have some similarities, which I think point to the fact that we can expect some action here. They both provided for additional stimulus checks for taxpayers and families, although they did not agree on the calculation of the amount. They both included enhanced unemployment benefits, although they did not agree on the amounts and time periods. They both talked about the extension of the Paycheck Protection Program and the automatic forgiveness of loans under $150,000. And they both mentioned enhanced employee tax credits for employers that would happen in 2021. So I think that the answer to the question is yes, there is more relief on the way. We just don't know when or exactly what it will be.
Exactly. And again, I used the word frustrating earlier, and it can be somewhat frustrating, but again, perfectly understandable. Regardless of your, as I said before, political bent, or personal feelings on whether some of these actions were the right ones or not, there's no question that there's been a lot of activity at both the federal, state, and in some cases the local level to try to address what happens when an economy stops itself or slows itself down. So thank you for that, Stephanie. There's a lot of stuff I'd love to go back and talk about there. We are almost out of time. I'll tell all our participants, hang with us for just a few more minutes. It's possible we may run a minute or two over 11 o'clock. I know we're within about 4 minutes of hitting it, but there's a couple other things we wanted to mention, and then I wanted to give you a little more information about how you can get more information. So real quick, Brad promised me we could do this in just a minute or two. He mentioned earlier, there's some stuff that has just happened, some guidance that just came out. Brad, what are the one or two big takeaways people need to know, even as we continue studying it, that they need to know about what just happened?
So a couple of things I want to mention that. I also want to circle back on one other thing that I forgot to mention earlier, which is in determining when you apply for forgiveness. One thing that I failed to mention is that if you spend your money before the end of the 24-week period, you can go ahead and apply for forgiveness. You don't have to wait until the end of the 24 weeks. That's important for a lot of businesses because of the responsibility to monitor. If you don't fall under one of the exemptions, you have to continue to monitor your full-time equivalent headcount. Once you've spent the money, if you want to go ahead and apply, based on the guidance we have right now, there's nothing that explicitly says that you can't do this, that you can stop your calculation of full-time equivalents at that point and lock that in and go ahead and apply for forgiveness without the obligation to continue to monitor full-time equivalents. So that'll be a big help for clients. And then there's some exemptions there with respect to wage reductions. So if you need help on that, let us know and we can talk through that. But I wanted to mention that you can. And then the only other thing I'll mention with regard to the guidance that was issued on Monday is there's two provisions in there. One of them deals with the cap on owner compensation that I mentioned at 2.5 times your 2019 average. They clarified that guideline to say if you were under 5% owner in a business that you could continue to be paid just like other employees do, and you don't have to worry about that cap. And then there's a number of guidelines with respect to how rent is determined and calculated. It really addresses things like where you have you lease a space and you sublease to somebody else and you have rent income coming back in on the sublease, how you deal with how much rent you can include there. And then also the last piece has to do with when you have related party rent. If you own your own real estate through another entity and pay rent over to that other entity, there's a limitation that's now imposed where you can't deduct or you can't include in your forgiveness calculation more than your mortgage interest that is paid out of the other entity. If your rent exceeds that, there's a cap on the mortgage interest amount. So we're still digging into these items. So if you find yourself in that situation, let us know and we'd be glad to help you.
Okay, great. Thank you, Brad. Appreciate that. Again, I think the overarching message there is this is it's happening in real time. We are working through it. There are a lot of lenders out there that are doing a lot of work around this as well to talk with their customers and make sure they are getting the advice they need from folks such as ourselves. So let's talk about a couple of things that we didn't talk about. Again, we're right at 11 o'clock, so bear with us for say another 2 minutes and we'll be wrapped up. There's stuff in the CARES Act we didn't talk about. Things with regard to the PPP we didn't talk about. One big thing being how the PPP is treated for income tax purposes. As everybody knows, by statute, the forgiveness of a PPP loan is not taxable. Normally, if you're forgiven of a loan, that's taxable income. That's not the case here. However, pre-existing tax law, and the IRS made sure to remind us of this, pre-existing tax law tells us that expenses that are covered with basically dollars that were never taxed, I'm oversimplifying, you don't get a deduction for that. Congress flipped a lid over that and said, we're going to fix it. They haven't fixed it yet. They've been a little busy. Are they going to fix it? We don't know. But right now, it's effectively taxable because of that provision. We also didn't talk about some other income tax changes in the CARES Act, some changes to retirement plans, things that were designed to help ease people's tax burdens and to make it easier for them to get access to retirement plan money. And that actually, and there's a number of other things we didn't talk about because we needed to focus on this. And even what we did talk about today, we were only able to cover at a very surface level to get it all in about an hour. That's a good segue to let you know about additional resources. So again, there's our information again. If you need more information, please reach out to us. We would love to talk to you. One thing I didn't mention at the top of the hour that I should have is that clearly we're having a conversation. This is not advice. You can't use it as advice. You shouldn't use it as advice. Your situation is unique. You need to be talking to an advisor. If you have an advisor, that is great. You talk to that person. If you don't have an advisor or if you need to talk to somebody else, we'd love to talk to you. So you can reach out to any of the three of us. We have other partners here who are working a lot in this area and related areas. We'd love to talk to you. Overall, the firm does have some additional resources on these and other topics. You can find us on our website, GranthamPoole.com. We have access to a number of resources there, including news updates, some thought pieces that we put out on a number of topics. A lot of them have been about the PPP and related topics lately. We also do a regular podcast that is semi-regular. It's coming out every week to 2 weeks, something like that now, just depending on need. So if you've decided that you can actually stand the sound of my voice, we would love for you to check that podcast out where we talk about these and other issues in depth, including some of the things I just mentioned, like retirement plan changes in the CARES Act and other things. So we'd love for you to check that out. You can find us again at our website, but you can find us through the website and through our multiple social media pages. We're on Facebook, Instagram, LinkedIn, Twitter, both corporately as a firm and many of us also individually. We'd love for you to check us out. We are 3 minutes over. We appreciate your patience. We appreciate your spending your time with us. Thank you for joining GranthamPoole today, and we would love to hear from you in the future if you have thoughts or requests on additional presentations or questions about this one. Thank you very much for joining us, and have a great day.